Welcome to the Mindie Molina Show. I have a special guest with me today, Tony. Tony, go ahead and introduce yourself.
Yeah, my name is Tony Lombardo, and actually it's my first podcast. I'm very excited. Minnie and we've done a few things together. I've been in this industry for about 10 years, working for retirees and post and pre-retirement. So, so we pretty well versed in a lot of different things that retirees are doing.
And today what we're focusing on is this concept of an IUL.
Right.
Okay.
Yeah.
So, which is indexed universal life insurance.
Right.
Yes. So this type of policy, it's like, okay, life insurance, right? Like, oh, we're going to talk about life insurance, and people have basic knowledge of what life insurance is.
Right.
And I think we're programmed to believe, well, it doesn't do anything for me.
Right.
Right. And not in this life. It doesn't do anything for me. That's more something for my family, for when I die. How do I solve the problems that I have now in this life? And so we're going to show you how you can actually use an IUL to solve problems that you have while you're alive.
Yes.
Okay.
Yeah.
And I love I like efficiency.
Mm-hmm.
Efficiency is so important to me. And I'm a very just get to the point type of person. And I also like for things to be organized and to have, especially in my financial planning, to have investments for a purpose with intent, right? Like invest with an intention.
Right.
And so one of the things that I absolutely love about an IUL is that it's so multifunctional.
Right.
That you can have this one thing that checks so many other boxes.
Right.
And especially for people that are like our age.
Sure.
This is like a foundation of how to really start building.
Right.
It's a really good building block.
Yeah.
To put in. So now I'm letting you take the lead on a lot of the back information on this. So kind of give us a basic understanding of what is an IUL? What is it? What makes it different than any other life insurance policy?
Yeah, so the IUL, Index Universal Life Policy, it like you said earlier, it really checks all the boxes. And the most appealing thing about it is the tax-free growth that's within the policy, that over time you have access to that money and it's tax-free. It has very good growth potential, right? Because it's attached to the S&P index with very high caps, meaning, typically when you get into investments, you can get into a cap situation to where the lender or the carrier will allow you to get a specific amount of interest, right? They'll cap you.
Yeah.
So with the IULs, there's very high caps in the tune of about 15.25%, and with zero risk, right? So as the S&P grows, you can get up to 15% and a zero floor. So if the S&P tanks in the uncertain market, a correction, your growth is completely protected, right? So that's the investment part of this vehicle.
Okay.
Right? Then there's another aspect of it as far as protection. So if you pass early, unexpectedly, it's on a whole life chassis, right? So what that means is it's going to last until you're 120 years old. It's not like a term policy to where, okay, it's term. So typically 95% of people that get into term policies, they expire, right? They never pay.
Yeah, they outlive them.
They outlive them or they cancel them. So this is something that you will keep your whole life. You pay into it, and you don't need a lot of money to get into it, right?
Right.
You don't need a large lump sum. So it's a monthly payment that you pay into it.
Okay.
It grows tax-free. And during that time that it's growing, it's compounding safely, it's growing aggressively. And if you want to buy a house or start a business or buy a car, or for most people, they just want another little egg in their basket of eggs for retirement, right?
Yeah.
And it's tax-free. So because it's on that chassis, that life insurance chassis, you have the ability to draw off the money, borrow off the policy tax-free. So, yeah.
Okay. So what I'm hearing you, and I just want to encompass this into kind of like a little story. And I say, do you have your household in order? Do you have your affairs in order? Like, is your financial house in order? Okay. Well, let's think about some of the aspects of that. One is, are you investing? Do you have any investments?
Right.
Are you building a nest egg?
Yeah.
Two, if God forbid something were to happen to you, are your spouse and children getting evicted? Are they going to be able to at least, I prefer 2 years. I think that a person should have 2 years to grieve, 1 year to grieve in place.
Right.
So We need a death benefit enough to just cover the bills for that first year. And then we need the second year to actually think clearly and make moves.
Sure.
Okay.
Yeah.
So a person, in my opinion, needs 2 years. So do you have enough either in savings and in investment accounts? Maybe not. Or do you have enough in life insurance to protect them? So the other thing is, are you going to be able to put your kids through college? Are you saving enough money for that? Are you going to be able to afford their first car?
Right.
So all these expenses coming down the road for your children. Like, have you done a 529 or account for your kids? Have you done these things? Okay, so, and then what are you doing about taxes? It's like, yes, I'm contributing to my 401k at work. Okay, well, that could be potentially a retirement problem later in life when you need to start taking from it, and now you have to pay all these income tax. So
Yeah.
when we think about all these things, this is what makes the IUL special. This is like one way that if all you did was this would be kind of like that Swiss Army knife where it like pulls out all the things.
Yeah.
It's like the Swiss Army knife of investments. So if all you can afford is to do, you're like, I can't get my affairs in order. Well, listen, what if you just, instead of contributing to your 401k, instead of, putting a little bit of money in your Robinhood account or whatever you're doing,
Sure.
what if you put $500 a month
Yeah.
into an IUL? Now now let's say you're fast forward, you have this ability to take a loan, right? To pay for a car, to put towards college
Right.
against this policy. God forbid something ever happens to you, your family's taken care of.
Yeah.
And guess what? What happens if the kids go off to college, they're doing great, you're doing great, and now you retire? Guess what? You've got the most tax efficient retirement strategy that there is.
Yeah.
Am
Yeah.
I right?
100%. 100%. There's only two other ways to get tax-free income. One is muni bonds, and muni bonds are, you have to go out 40 years right now to get a decent rate, or if you're going to convert to a Roth. So realistically, reality is that 40% to 45% of people are going to run out of money in retirement, right? And that's kind of a scary statistic. So this is something that you can do very easily. Doesn't take a lot of education to do it. And it's almost like a forced savings account. So I know that if I pay into this money and I know it's protected, I know it's safe, I know it's going to pay tax-free, and over time, I'm going to have a pretty significant bucket of money that I could draw off of for, like you said, any type of reason, right?
Right. Yeah.
If I pass early.
Also having an emergency savings.
Sure. And it's like, it like you said, it checks all the boxes. If I pass early, unexpectedly, my family's protected, right? And I always use this story is that my uncle passed not too long ago, and my cousin actually called and asked for money to bury, right? To bury him. So he didn't really have the opportunity, because his uncle, he's a great guy, but just didn't have the insight or the education to secure. Wasn't prepared, right? So he could not bury and grieve. So he had to worry about this money thing. And of course we gave him money to bury him, but he was embarrassed that he had to ask and grieve at the same time. So it was a bad situation. So, nobody wants to go through that.
Right.
So there's so much opportunity to really take care of these things to where you can protect your family, protect your retirement. And one thing we didn't mention, it has living benefits as well, right?
Yeah.
So, which is huge.
Another piece of the Swiss Army knife.
Another piece. So it's huge. And I wrote up
disability. If you were to get, we know about disability insurance, but this is a way, right?
Yeah. Oh yeah. It's huge. It's actually outside of the tax-free income. It's my favorite benefit out of this. The death benefit is great, of course, but if you can't work for some type of medical reason, you could access the death benefit, 80% of the death benefit tax-free.
Right.
Right. So
if you were diagnosed with something, and this is like I just went through this with my brother.
Yeah.
Who had,
gave
him 3 to 5 years. He lived 4 and some change.
Yeah.
Having that kind of feature for him would have been amazing.
Huge. It's a game changer. And I use this example. I wrote up a construction worker about 6 months ago, and he had a $200,000 benefit, and he had to get a hernia operation, right? So he couldn't work. His wife didn't work. He had 3 kids, right? So what he did was he called me, said, I need to activate this bucket of money, this emergency bucket of money. So it was a life-changing circumstance. So he was able to keep the lights on, pay the bills, keep food in the fridge. It was a game changer for him, right?
That's amazing.
It was huge. It was huge. So,
And that makes you feel so good.
oh, it was great. It was great. You know,
Sure, he was happy.
it was like life changing for him.
Okay, so with life insurance, I feel like sometimes it's one of the last things that people actually do.
Yeah.
And then when they have a child, they go and grab a term policy for cheap. But this is actually one of the first things that I think people should do
Yeah.
when they're getting started. So young, especially like young husbands and wives, fresh out of the gate. This is a great way to build that foundation
Yeah.
because it's covering all the bases like we just talked about.
Right.
It is a efficient way to get all of your affairs in order. So now you just brought in disability. God forbid something happened to you, or even if it's short term, doesn't mean you have to be terminal or debilitated for the rest of your life.
Sure.
But something as simple as a hernia surgery, they're going to help you make up the difference while you're out of work.
Yeah.
And if you need later on access to that money, because I think a lot of people think, oh, life insurance. I'm paying for life insurance, but what if I need the money?
Yeah.
I don't want to pay too much for life insurance because I need to have this nest egg in case I need something.
Just in case.
But that's not how this is.
Right.
You actually still have access to the money. So if you need the money, you can get a portion of it back.
Sure.
To work.
Yeah.
To use for, emergencies or whatever comes up.
Right.
So I think the accessibility is a really big part.
Yeah.
And then like you said, the investment side, the growth. This money isn't just sitting there in a
No.
life insurance policy. It's invested.
It's invested.
It's growing.
It's typically invested in the S&P, which historically is the best index you can be in.
And it's safe.
And it's safe.
So basically what that means is that when the market goes up, your money that's in this life insurance policy has the ability to grow with the market.
Right.
When the market tanks, it does nothing. Zero is the hero, we call it.
That's correct.
So it just sits there and waits for the market to rally again. So it's like this step up kind of approach versus up and down, up and down, up and down.
Sure.
Which
Yeah.
would be more, you can also have a life insurance policy that does that, but that's not the one that we're talking about today.
Yeah, that's
correct?
not what we're doing. Yeah.
So with this specific life insurance policy, who do you think could benefit from it the most?
Well, it really depends, right? So it depends on your life cycle. So as someone that's 20 or 30 years old that really is focused on their retirement and building a tax-free retirement bucket of money, this is life-changing, right?
Right.
Get into it early at 20 or 30 years old. You can put in, $200 a month. And by the time you're 65, you could have up to $200,000 in here tax-free. So it's life-changing, right?
Right.
Even if it's an older individual at 40 or 50, there's still going to be some growth, very good growth. You still have access to the money, but now you have the living benefits, right? So now you're thinking about, okay, if I can't work, what if I need someone to come to the house because I can't earn money? If I get hurt or whatever the case may be, I can access it. And not only that, is that you have the death benefit. So, obviously the more you let this thing sit and the more money you put in, like any investment, the more you can get out of it, right? So if you have a longer horizon of time, then it's going to be extremely beneficial, even beneficial for a 50 or even 55-year-old, right?
Yeah.
But it's just you're in a different life cycle than a 20-year-old.
Yes.
Yeah, so it's just different. So everyone's different. It's not a one-size-fits-all type scenario.
Yeah, I think goes back to how many different ways that you can use it. Like I call it like the Swiss Army knife.
Yeah.
And for how many, and for someone who's older who really wants to use it specifically for retirement income and to get out of this 401k IRA tax trap, which we'll get into.
Yeah.
But they can typically afford to dump a lot more money into it.
Sure.
To create that tax-free income in retirement. So that's one approach. Or you have the younger people who are just getting started who really or maybe really want to build that savings and grow it, but can't afford a really high premium.
Right.
But over time they can increase the premium, correct? A lot of them have flexible premium.
Yeah, that's the beautiful thing about it is that you can, and I tell my clients to do this, to add more, right?
Right.
It's our job to keep the payments affordable. It's all about affordability, right? It's all about what you can afford. So we don't want you thinking about this. We want this to be painless. So when it comes out, you don't even think about it. Then before you know it, you got a big bucket of money. But at the same time, you have the ability to pay more towards these policies. It's limited, right? There's an IRS tax code at 7702 that prevents you from putting too much into these policies.
Right.
But that's where your agent comes into play. These should be managed like any other investment. It should be managed properly, right?
Yeah.
So from the IRS point of view, it's like, okay, this is a phenomenal investment. If everybody does this and you can put unlimited funds in it, nobody would do a traditional IRA,
I know.
401k,
That's what I was going to say.
right?
If you know the IRS is getting involved and they're saying, whoa, whoa, whoa,
Yeah.
you can't,
It's too good.
you're going to limit this.
Yeah.
You can't just keep doing this. Like,
Yeah.
then it's obviously a good thing.
It's a good thing.
It's
Yeah.
something worth looking into.
Sure. And then I have clients that do too. They do multiple, right?
Right.
If they want to do that, it just for multiple buckets of money. If they want to just extend their exposure monthly, depends on what you can afford, right? So yeah.
Let's the 401k and 403bs,
Yeah.
457s, your typical retirement accounts that people contribute to through their job, versus taking that exact same money, that portion of your paycheck, instead of contributing it into these, what some people call tax traps. What if you contributed that to an IUL and paid for an IUL instead?
Mhm.
I want to compare the differences on how those both work and what makes one better than the other.
Okay.
So let's first start with the amount of money, okay? So how much do you have to contribute to the 401k? If we're putting in a 401k, one of the benefits is you get the match. So that's a down
Right.
thing if
Yeah.
your company doesn't match. So for that side, the 401k wins. But let's say you're contributing a certain portion of your check, and however much that is per month that you're depositing over there, you're depositing over here.
Yeah.
What is it that you're getting now? Let's say it's $1,000 a month. I'm paying $1,000 a month into my 401k. I'm paying $1,000 a month into my IUL.
Yeah.
How is there like a today benefit
Yeah.
for that?
Well, yeah, the primary difference between the two is there's a few glaring differences. Now, one of the glaring differences is really the taxation of it, right? So it's huge with the IUL. It's really the most appealing thing about it is that as you put money in, it's going to grow. It's going to grow tax-free rather. Compared to the 401k, it's going to grow, but it grows tax-deferred. So you don't really have to pay taxes on the seed, so to speak, any money that you put in, but you have to pay taxes on the crop when you harvest it at the end of when you're ready to pull money out, whenever you're ready to. With the Secure Act 2.0, the RMD ages have changed from 73 or 75, depending on when you were born. If you were born after 1960, your RMD age is 75, and before that is 73. So it's changed, right? So most people...
It'll probably change again.
Yeah, that's today. You're absolutely right. So, if you're going to retire in 20 years, it might change a couple times, right?
So what, I think about it, it's like immediately, if I'm investing this money today, one of the benefits of, it's like, yes, I'm putting the money in the 401k, but we really just have to backseat that money. It's like, we don't even have access to it for years and years. Why? Because if we do take money from it, we're going to be penalized if we're under 59 and a half.
Right.
Where if we have the money in the IUL, it's accessible today. Now we can have access to it.
Yeah.
And then this is there as a little bit by bit building a legacy. This immediately, I have a legacy.
Yeah.
I've immediately bought a legacy for my family. God forbid something happens to me, right?
Day one.
And I immediately have disability if something happens to me and I can't work.
Yeah.
So I have these benefits that I immediately have that with a 401k, I don't have any benefits from that for decades to come.
Right.
Right?
Yeah.
So that was one, I think, really big difference. Another is the taxation on that benefit.
Mm-hmm.
So from just a legacy standpoint, if I leave the world, okay, now fast forward, I've built up my 401k to a substantial amount. I've been paying into it for decades. I'm retired and I die. Okay. I've been paying into it for decades. It has accumulated. My death benefit has continued to go up, 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 up. And now let's say both of these, I have $1 million IRA or 401k.
Mm-hmm.
which in this scenario is the same thing. Okay, for people that don't know the difference, that is the same. Or I have this $1 million death benefit.
Right.
Okay, and I pass away.
Yeah.
And then my kid inherits this money.
Yeah.
What is going to happen? You go ahead and answer the question.
Okay. Well, no, it's full. Anything you take out of the IRA is fully taxable. So with the Secure Act 2.0, I believed in inherited IRA, you have 10 years to deplete that IRA, right? So you have 10 years as far as the Secure Act. So you can gradually spend it down, right? So you'll have to take your distribution. So it's unless it's a spouse.
And it's going to be taxed as income. So if I'm making, let's say I'm making $200,000 a year, and now I have to spread it out over 10 years, that's an extra $100,000 that I got this year that is going to be taxed in the higher tax bracket.
Oh yeah.
Because it's going to go on top. So it's going to look like I made $300,000 this year.
Exactly.
So now this money is not, I'm not going to get all of it. I might lose 32 or 24% of that money to Uncle Sam.
Exactly.
What happens to the $1 million death benefit?
Yeah. Well, that's a lump sum.
It's a lump sum, 100% tax-free.
Tax-free.
And the only reason that people do take the distribution for an IRA or 401k over 10 years is because of the tax problem.
Right.
You can take it in a lump sum.
Yeah.
But guess what happens? That $1 million that I just got from the IRA is going to go on top of my income, taxed as if I got it from my job, and taxed at 32% or higher, the majority of it.
Maybe higher depending on the value of the 401.
Yes.
So you could be as high as the highest tax bracket now is 37.
37.
That's
40% gone.
Yeah, 40%.
I'm not even going to get that money. Uncle Sam inherits that money.
Yeah.
But again, with this IUL side, that death benefit, I can get it on day one.
Yeah.
There's zero probate. I don't need a will. I don't need a trust. I don't need any of that.
Right.
And immediately I have that money and I get every single penny. And how much does Uncle Sam get of it?
Yeah, zero.
Nothing.
Zero. It's all yours.
So this is what makes it so amazing and different. And this is why people are saying, hey, why would I do a 401k when I can do this?
Yeah. Yeah. So it's really, obviously it's all about having a lot of little eggs in a lot of little baskets, right? So 401k, it has its value, of course, especially if you're
going to get the match.
Yeah. If you get
free money,
if you got that match, it's beautiful, right? Free money. So, but then if you can have this on the side to where, okay, I know my family's protected. I know if I get hurt, I can access it. And it also has a terminal illness rider. You could access the full death benefit if you get diagnosed with a terminal illness. So, and that's indemnity. So there's two types of ways to get, and this is an important fact. So there's two types of ways in these like long-term care disability policies. There's indemnity.
Okay.
And there's reimbursement. Okay.
What's the difference?
So the difference between the two is that reimbursement is that you have to pay these, if you need someone to come to the home, or if you need help, you can't move around, you could access these benefits. But the reimbursement policy is that you have to pay out of your own pocket, and then the insurance company reimburses you, right?
Yes.
So, I mean, nobody wants to do that, right? Because for the most...
It's like paperwork
and you're going to get drilled by the insurance company, of course, which happens. But on the other end, there's indemnity products. There's indemnity, which these IULs are. They're indemnity. So the insurance company just sends you a check, right? You get a note from your doctor that you can't perform 2 out of the 6 daily activities of living, that you can't work because of a medical reason. It could even be emotional, right?
Yeah.
That happens to some people. They can't work because of depression, which is big.
Mm-hmm.
If you can't work because of that, you can access the death benefit tax-free. You get a note from your doctor. They send it into the carrier, and boom, you get your money.
Yes.
So it's huge.
But that's a huge win that you get right out of the gate as soon as it's issued.
Yeah. It's now there is a 90-day waiting period, right? Which is pretty much with any policy, right? But at the end of the day, it's a game changer if you don't have it.
Right.
It's a huge game changer if you don't have it compared to if you do have it. And just peace of mind that if you do get hurt, I have this money here that my family's, I'm going to be able to pay the mortgage, keep food in the fridge. It's just peace of mind, really. Yeah. Which is huge.
I really love the IUL policy specifically because of all of these different features that we're talking about. Yeah. We always think of life insurance as just like a death benefit a box to check for our family,
Right.
and you're responsible if you have it, and you're not responsible if you don't. Like,
Right.
there's like I think there's a social thing on it too. You're like, oh, you don't have life insurance.
Yeah. Yeah.
But this is not just that. These are so many other things.
Yeah. Yeah. Yeah.
It accomplishes so many other things. So one of the other tax differences, again, comparing the two, the 401k and the IUL. So let's say, again, we're fast forward, we're in that retired space.
Yeah.
Everything's good. We've worked 30 years. We have this giant IRA, and now we have this giant IUL,
Right.
right? So now I want to cash it in.
Yeah.
I want to take 500,000 of it and buy a home far away where I'm going to retire.
Right.
Okay. So what is the difference? Because one, the IUL is tax-free. There's a tax-free strategy.
Right.
And I'm talking about a lump sum. And then with the IRA, if I take a giant lump sum from that, what are the differences in from taxes?
Well, it's all taxable. It's fully taxable from the 401. But if we think about taxes, let's think of a higher net worth individual, which, obviously there's people out there higher net worth. So what's the major problem of a high net worth individual that has a huge IRA?
Taxes,
right? So they built this huge tax bomb, this huge 401 or IRA, and they planned great, but they overplanned, right?
Mm-hmm.
So now I have to take these distributions. I don't need them, but I have to take them, and they're fully taxable.
Yeah.
So you're under the thumb of the IRS because they're saying we want our money, right? Yeah. You've had to enjoy all these years of deferred taxes. Now you're 73 or 75. We want our money, right? So rather than fund this 401, why not put it into the IUL to where there's no guidelines for the IRS as far as taking money out? Yes. You can take it out whenever. It's totally protected, great growth potential. And so there's no RMDs. So now you've got maybe a smaller IRA, which, okay, that's great. It's not going to affect me tax-wise because it's a huge tax bomb for you and your kids, right? Yes. So it's massive. It's massive. So if you are a higher net worth individual, this is a game changer, right?
Yeah.
So
because when you go to take in the same scenario, when you go to take money from the IUL, you can take it as a loan and against the death benefit.
Sure.
So instead of withdrawing the actual cash, you take it in the structure of a loan that you're borrowing from yourself.
Yeah.
You can pay back or not.
Yeah, you could pay it back.
When you die, the death benefit pays it back.
Correct.
But when you receive that money, how much do you pay in taxes?
Yeah,
Zero.
So, and a great thing is if you do decide to take it as a loan, the money is still it's almost like it's still in there.
Yeah,
because
it's growing
it's
still.
Still growing.
You're getting credited on the full amount that's vested.
That's right.
Where with the IRA, if you withdraw, half of it, you're going to have to pay top dollar tax, 30% or whatever it's going to be, 20 to 40 something percent.
Sure.
Whatever taxes are during that year and wherever you fall, but still a lot in taxes. And not only that, but that money's gone. It's not growing anymore.
Yeah.
So that part of your investment is gone and you're not going to receive any interest on that.
Right.
But with the IUL, it's still in there. It's still growing with interest.
Correct. Yeah. Mm-hmm. So if you do take it in the form of a loan, every carrier has different interest implications on the loan itself, but it's minimal.
Yeah.
It's minimal.
But generally, so these are the concepts that work. So let's talk about retirement too. The last thing in terms of taxes is that, let's say you use it for actual retirement income.
Yeah.
Okay. Now you want to turn on your retirement income. You've built these two, one here, one there. We're going to compare the differences. It's kind of the same as that large distribution.
Right.
When you start taking money from your IRA, say you're taking $50,000 or $60,000 a year from this IRA to pay for your standard of living, pay your bills, buy your groceries, go on trips, or you're taking $60,000 a year from the IUL. So the same situation, the $60,000 a year that you get is complete income and taxed as ordinary income.
And you're not going to get 60.
And you're not getting the full 60,000.
Yeah.
They're going to take out their cut of the taxes. And then it could also throw you into this other taxation on your Social Security,
right?
Because of the provisional income and how Social Security tax is calculated, that IRA money can really cause you to get taxed at the higher bracket of Social Security. It could also throw your Medicare premium up.
Sure.
Because now you're receiving all this extra income. And if you reach a certain threshold in income, now you have to pay higher amounts in Medicare premiums.
Yeah.
These are consequences, a ripple effect that people don't realize.
Yeah.
So if you're taking money from the IRA, causes problems, causes a lot of taxation, taxes, or the government is taking all of what you've worked for. Just if all you did was, instead of contributing to that IRA or building that big IRA, if you had built the big IUL in retirement, and now say you're taking $60,000 a year from that in the form of your loan,
right?
It does not affect it. First of all, it's not sent to you as income. So the IRS doesn't even recognize it as income.
Correct.
So it's 100% not taxed as ordinary income.
Yeah.
And then second of all, it's not going to impact how much you're taxed on Social Security, and it's not going to impact how much you have to pay for your Medicare premiums.
Yeah, it's big. And let's flip the coin, or someone that doesn't have big IRAs, right?
Right.
They didn't plan, right? They didn't plan. So, there's a lot of uncertainty with Social Security. Congress says that Social Security is going to be the Social Security Administration said that Social Security is going to be dramatically, it has to be cut. If Congress does nothing by the year 2035, Social Security is going to be either dramatically cut or wiped out if nothing's done, right? So if you didn't plan for retirement, which most people don't, right, the proper way, and you're planning on Social Security, that may not even be around, right?
Yeah.
And that's a reality. So what does Congress have to do? They have to make some decisions. So they're either going to increase taxes, right?
Yeah.
To supplement. They can stretch out the retirement age, right? So you can't access Social Security so you're older, much older, right? To build up that plan, the fund itself. So, we have, it really just kind of helps both sides of the coin. There's somebody that's high net worth or someone that didn't plan so well.
Right.
And that doesn't have the mentality to save, right?
Yeah.
And this is a forced savings account, right?
Yes.
I know I have to do this. It's going to come right out of my account. And before I know it, boom, now I'm an investor, right?
Yes.
Now I have.
So I will interject here with with this concept, because I used to say, well, you need to save money for retirement. But saving money is like a difficult thing for people to grasp because they know how much they need to spend.
Right.
So I started saying, spend money on retirement. You need to start spending money on retirement. We can relate to that. Okay,
Sure.
These are all the costs that I need in life. It's part of my budget.
Yes.
And this I need to spend. So just piggybacking off that point, it's like, when you're calling it a forced savings, I totally get it, because now we're budgeting it. It's part of our monthly budget,
Right.
where we don't call it saving. It's like, this is a cost.
Yeah.
I have to pay for this policy.
Have to do
it's a
it.
cost.
Yeah.
And now we're programmed to pay our obligations.
Yeah.
We make our car payment. We make our mortgage. We want to pay our homeowner's insurance, pay our car insurance. We have to pay any medical bills that come in. These are all costs and expenses that we mentally compute and prepare for.
We have to do it.
When you do it with the life insurance, it's like, oh, I compute it and I feel obligated to do it. If I just say, set up a savings account, put this much money in it, you start feeling like it's like, no, I'm going to need it to cover all these expenses. It's a mental thing.
Right.
It's like a mental block.
Totally.
So I totally get that. And that actually works.
It does.
One reason 401ks work is because nobody ever sees the money.
It's forced.
Yeah.
It's forced.
Forced.
Yeah, it's forced. And this is the same thing, though. It's forced, right?
Right.
Because the carrier will take the money right out of your account and you never see it. It's painless.
I'm going to tell the story about some clients that I worked with recently who, younger, probably like somewhere between 45 and 50.
Okay.
And have 2 children. One is still in the house. The other one is a firefighter, and young still, just getting started.
Yeah.
And then, but she, the wife, has some health issues. Okay. And it works with him, but doesn't work a lot. She's more of the homemaker, and then supports him maybe through bookkeeping and stuff like that with his business.
Okay.
He has a small business. He's doing really well. He's growing exponentially. It's kind of like the snowball started, and then he
What kind of business?
architect.
Oh, cool.
Architecture. And then he aligned with another company. So that really brought in more. So he's really growing, and he's saying, okay, I've got extra money.
Right.
We need to start investing because they don't have a nest egg. He's all of his money has always went back into his career,
Sure.
taking care of her, raising the kids, making ends meet. He's never really been in a position to have investments, and which is very relatable to a lot of people. Like building a business and getting started, there's all these expenses early when you're building your family.
Well, not only that, is that you have to realize that when you're building a business, you have your personal expenses,
Yes,
and you have your business expenses.
Yeah.
Right? People
Yeah.
don't realize that.
and investing in your business is an investment,
Yeah.
right? Like,
Sure.
the idea is that you're going to build something that the return on your investment is worth it. And
Yeah.
so that's what we're all looking for, is what is the return? What am I going to get out of this?
Right.
What are the risks? What are the rewards?
Sure.
So in their case, I'm sitting with them and I'm saying, okay, you have, and they had about 1,500 disposable money.
Okay.
Their plan when they met with me was, okay, we listened to you on the radio, we want to invest. And they're thinking, open an account, start depositing money monthly. But then once I did the full fact finder, I call it, like really sat with them and really did a full diagnosis of their overall life, from, her ailments to his career, where we're going, where we've been, what do we have to work with, and what are the opportunities, strengths, weaknesses, all of it, of them. Then I said, okay, well, I honestly think that my recommendation was an IUL. And the reason was because, number one, if something happened to him, there's no other income coming in.
Ugh.
And I wanted him to have that disability feature. I said, yes, you need to have a retirement plan. And that's what you're thinking this $1,500 is for. But you also need that if something happens to you, they have a mortgage on their home that she can't afford. And that means that either their son is going to have to move home and take over his dad's debt, or she's going to have to move, right? So something's going to change immediately, effective immediately.
Yeah.
Because there's no nest egg to dip into to carry them on. So
Scary.
you definitely need life insurance.
Sure.
And she's also, because of her sickness, in a position that she can't go back to work.
Right.
Not to mention you have a child in school still. So life insurance was huge. It's like there are a lot of potential threats in your life right now, in your little house, your financial house.
Yeah.
And so they're going, okay, you're right. And but it's like, okay, so their mindset again was, well, if I spend, okay, so we got to pay, so now we need to buy Aflac or something to cover the disability, and now we need to buy life insurance. So what? We'll only have about $1,000 left to invest.
Right.
And I'm like, okay, let's look at this. So I laid out all the different scenarios. Like, what if you did that, right? What if you, or what if we just invested it all in the stock market? What are the different concepts that we could do? What are the different strategies? And the IUL, that's what they ended up doing. That's what they chose. They said, this is right for us, because by them doing that, he has a retirement plan. If he retires at full retirement age and collects Social Security, which we pulled his numbers, and uses the IUL, he's going to have plenty of income. It's like $60,000 in retirement.
Nice.
So they're going to be fine. God forbid something ever happens to him, whether he is short-term disability, long-term disability, he becomes sick.
Right.
He's got income coming in that he can take from that to supplement his income.
Yeah.
And God forbid something ever happens to him, his family is covered for 2 years or more.
Sure.
They can be debt-free. They can do what needs to be done, taken care of.
Yeah.
He's not leaving a burden to his oldest son
Right.
to figure out. And just by that one move, and they have been committed. They are like, this is perfect for us. And again, it goes right in their budget. They make that payment and they have all of this peace of mind. Like, he went from feeling like I am a hot mess
Yeah.
to feeling like, oh, I got it together.
Yeah.
It's
huge.
And they do. And
Yeah.
I feel at peace with them,
Right.
because I know that there are some factors there that are not typical, but I have no concerns. I
Yeah.
know that no matter what happens, everybody's going to be okay.
Yeah. Yeah. No, absolutely. And he could always pay more on the IUL too, right? So instead of
Yes.
if you
And that's the thing too. We showed that, like, as he continues to grow
Yeah.
his business,
Right.
he can continue to add money to it.
Sure.
We did a base that was affordable.
Right.
And as his company escalates and grows, he can grow his nest egg and everything else.
Pay more. Yeah.
And guess what he doesn't have to worry about?
Taxes. All right. Big for a self-employed entrepreneur.
We looked at like the solo 401k option for them. The IUL was better.
Right.
We looked at the Roth. IUL was better.
Yeah.
You know?
And
it's better.
It's better, and it's the growth component within it is so aggressive, right?
So that it's like
so aggressive.
And you know, when we do run the illustrations and you actually see the growth, and you see the investment portion of it, it's like it's easy to understand. Oh yeah, okay, I died. They're going to get this. But it's hard to visualize the investment component.
Sure.
And then when you actually see it on your quote based on your health, your life, you're like, oh wow, I am investing.
Yeah.
You know, it's just like it checks all the boxes.
Right.
And it just makes you have peace of mind knowing that you're being a good steward of your money and your family.
Yeah. Yeah. So, yeah, I mean, it's really, you know, it all depends. You know, I've had a 35-year-old that put in, just to kind of give you an example, it was $200 a month, right? And he was 30 at 35, and if he paid into it for 30 years, he was able to access $150,000 of tax-free income, right?
Right.
It's crazy, right? Now, he didn't have a family, so you have to understand with the IULs, there's a couple ways, there's different ways that you can structure them. So you can structure them to where, okay, I don't have a family, I want to reduce the death benefit as much as I can, because I don't have a family, but I eventually will, right? So I will. So, but for now, I just want the growth, right? I want as much growth as I can. So I want to take advantage of this chassis, which is life insurance, and I want to throw as much at this as I can and reduce the death benefit, because in essence, by reducing the death benefit, you reduce the cost to keep that policy alive, because the death benefit is low. Right. Yeah. So the higher the death benefit, the more it's going to cost for a higher death benefit. Right. So everyone's different. Right. Everyone's different. For your guy, it was, okay, I'm going to probably do, I want the death benefit, but I also want growth. No problem. Right.
Yes.
We can do that. So it's so versatile in that sense, to where it not only has multiple advantages, but you can structure it based on your living, where you are in your life cycle. Yes. So it's very cool in that sense.
So can you add a term rider? Like, let's say they have a mortgage, they have 20 years left on, and they want to beef up the life insurance for that remaining 20 years just to pay off the mortgage if something happens and then it ends. Is that a feature that you can do on some IULs or no?
Well, not that I'm aware of. Yeah. No. It's really, but you could always get another one, right? You could always get two.
Or you could decrease the value, because is it flexible? Like, let's say they have the death benefit at a certain level now, and 20 years from now when the house is paid off, can they reduce their death benefit? Yeah,
that is definitely an option, to reduce it and increase what you're putting in and increasing the cash performance at the same time.
Right.
So it's very versatile in that sense. So it just depends. You have to have a good agent, right? Someone that's going to listen.
Yeah.
Someone's going to just, like yourself.
And someone that's going to be there in 20 years. There's somebody that's actually going to work with you for a long-term period.
Right.
Because I also know there's life insurance salesmen.
Yeah.
Right? What we're talking about is financial planning. We're talking about solutions here. We're not talking about just a transaction of going and buying a life insurance policy that you can do on the internet.
Yeah.
No.
This is not a product sale.
No, it is not. It's a very customized, flexible. It does require some management on our part.
Of course.
And that's why I want to work with you, people like you, is because we're in it for the long haul. This is what we do.
Right. Yeah. And we're always on a fiduciary capacity, right?
Exactly.
So we're always looking at the best interest of our clients. So
100%.
So it's all about having a conversation and seeing what is the best way to structure it, and then managing it. It's something that has to be managed on an annual basis, minimally at an annual basis.
So let's talk about that. What about people that took out life insurance a long time ago?
Yeah.
I want to cover two things. One, redoing an old policy, right? So policies that are outdated because of the mortality tables, they update. Like, people, you can buy insurance at a lower rate now because people are living longer.
Correct. Yeah.
Right? So life insurance has become cheaper because as those tables update, they update in our favor.
Right.
People are living longer, making life insurance cheaper. And the other thing
Correct.
I want to touch on is, approval. So let's start there.
Right.
Like, what is the approval process? Because there might be people saying, yeah, that sounds great, but I would never get approved because I'm diabetic.
Right. Yeah. So that's a huge part of the IUL. People think that you have to be the picture of health, which you don't, right? So these carriers, there's a couple ways to do it. So these carriers aren't going to come to your home and poke and prod you. You don't have to run around the block or pee in a cup or anything else like that. Yeah, nothing like that. So that's really the IUL is becoming so mainstream, and it's becoming so popular, is that these carriers have come out with these ways to where it can be very efficient as far as approving you. So there are knockout questions. So what will happen is that even if you have high blood pressure or diabetic type 2, you could still get approved. Okay. Certain situations, of course, it will knock you out, right? But, it has to be extreme. So you'll be surprised as far as what these carriers will do to get you approved and get you involved.
How easy or difficult is it for someone to say, hey, Tony, this is my situation. Do you think I have a chance?
Yeah. Well, you have to realize that when we're doing the approval process, it's called an express approval, which is great, right? Because what they do, the carriers, like I said, they're not going to come to your home. You don't have to do a full physical, which is a huge advantage to a lot of people.
Okay.
Because they can kind of fly under the radar with certain things, okay? So on the phone, what we'll do is we do a couple different things. So we look at your Milliman script, which is a database of any prescriptions that you've taken in the last 10 years.
So like a credit report for drugs.
Yeah.
Your drug history.
Exactly.
Okay.
So that's all accessible, right, to the insurance company. And then in addition to that, they look at your MIB, which is an acronym for Medical Investigation Bureau.
Okay.
So they look at any procedures that you've had in the last 10 years, anything that any hospital visits, and they can see it, right? So they'll do a search on that. And if that checks out, you can get approved, right? Because the advantage of that, rather than going fully underwritten, is okay, they come to your house, right?
Right.
And your your blood pressure is super high that day.
Yeah.
Or something's going on. Something's off, right? Mm-hmm. And it veers your chances this way, and the values are very comparable as far as going fully underwritten.
Yeah.
It's almost exactly the same, really.
Wow.
As far as the value.
Yeah, I mean, I like fully underwritten is a pain for everybody. It's painful for me.
Nobody wants to do
it.
it.
We need this. Okay, now come sign this authorization form again. So this express underwriting way is just that simple.
Yeah.
Really?
It's that simple. You can get approved with
simple. I told you I was an efficient
Everybody does. Everyone loves simple, right?
Easy. Just give me the approval.
That's it. That's
Thumbs
all.
up.
Yeah, that's all anyone wants. So it's
Okay.
like it's fast, it's easy, it's efficient, right?
Wow.
Within 1 hour, we can get you approved with a policy. And we work with all
You
A-rated.
do that over the phone.
Over the phone. Yeah.
Wow. Awesome.
So and
So there's really no excuse.
no excuse not to do it.
Yeah.
No excuse not to do it.
So what about somebody that already has a policy?
Okay.
Okay. Let's say that they are, approaching retirement. They've had a policy for years. It's got a little bit of cash value. Is there a benefit in shopping it or seeing if you can get qualified for something better?
Well, there's a thing with the IUL. There's always a specific way to fund it, right? So by putting a lump sum into these policies, the lump sum has to support the death benefit. The death benefit has to support the lump sum. So, and I get that question a lot. So why don't I just dump $50,000 in this?
Right.
That's the wrong way to do it. Because if you think on the insurance company's aspect and point of view, okay, you're going to give me $50,000 lump sum single premium. So I have to make your death benefit $1 million, right? Because you gave me $50,000 in lieu of giving me $500. Now I can make your death benefit, $200,000, right? And so this way we keep the cost low. You're only paying
the cost of the insurance.
The cost of insurance low, correct. So there's something called a modified endowment contract, right? It's a MEC. So you can't MEC these policies because you lose the advantage of the tax-free growth, right? So there's very specific ways to fund these. That's where the agent, someone like yourself or myself, will steer you the right way. and say, look, this is not how we're going to do this. This is how we have to do this to be as efficient as possible, right?
Yeah.
So,
And to fulfill the needs. So if again, that's why I say it's not transactional, right? It requires some planning, because you might have someone, let's say they do have 50,000 in cash value.
yeah,
Whether it's 2,000 or 300,000 in cash value.
right.
There's a way typically to improve upon that and give you more assets, just because of what I said about the mortality thing. So it's worth the investigation, that the work that we do to see how we can position it to better suit your needs.
Right.
Because number one, needs change.
Yeah.
The policy that you took out 20 years ago is going to be used probably differently than what you thought then.
100%.
Okay? So now we can use it to your advantage or to fulfill whatever needs you have. And that being said, it might be a really high death benefit. Like, look, just max out the death benefit. So then maybe the lump sum and some premium, like that strategy is going to be different than somebody that says, I need retirement income.
Right.
Let's max it out for retirement income. And then death benefit is not the priority. Right. So then we use it a different way, and maybe it's more of a trickle effect. But that's where we come into building a strategy that is custom fit for everybody individually.
Yes.
So,
yep.
Well, this has been very awesome.
Yeah.
Thank you.
I love it.
On the show. I really appreciate it.
My first podcast. I'm excited about it. I'm going to watch it.
And thanks for enlightening us on all the IULs, because, well, first of all, I'm excited about this whole express underwriting.
Right.
Who wants to go through all of that? But I also am a huge supporter, obviously, of the IUL product. I think it is just such an amazing financial tool in all kinds of different areas of life. Yeah. That covers so many things for the money, for the amount of money that you can put, that it costs you, and what you get in return. Yeah. Is amazing.
It's affordable. Yeah. And it's sustainable. Right.
And again, the Swiss Army knife of an investment. The
I like that.
return is amazing. So
yeah.
Thank you, Tony.
All right. Thank you. Awesome.